It's Friday, May the 27th. Welcome to Business Incorporated, coming to you live from Lagos. On the program today, Nigeria's Securities and Exchange Commission bans BGL Managing Director Albert Okumaba and his deputy Chibundu Edozie from participating in capital market activities for 20 years. Fitch warns South Africa of quick fixes in run-up to local elections. Plus, what is driving the Egypt's economy as the country overtakes South Africa as the second largest economy in Africa? Well, we'll begin here in Nigeria, where the Securities and Exchange Commission has banned BGL Managing Director Albert Okumaba and his deputy Chibundu Edozie from participating in capital market activities for 20 years. This information is contained in a circular posted on the Commission's website. The circular is entitled SEC Administrative Proceedings Committee gives its decision on BGL Securities Limited and 22 others. The Commission also ordered Okumaba's companies to refund to investors over 2 billion naira. The ban followed complaints by investors against Okumaba and his company over failure, refusal and neglect to liquidate their investments in both the guaranteed consolidated dated notes and guaranteed premium notes, among others. And Fitch has warned South Africa of quick fixes in run-up to local elections. South African authorities should avoid populist measures such as introducing a minimum wage in the run-up to the local elections in August. Fitch, which rates the debt of Africa's most industrialized country at BBB-, one notch above speculative grade, is expected to publish a review of the country's debt rating on June 3. The government is mulling the implementation of a national minimum wage but has not set a date for its introduction. The underperforming economy, expected to grow by less than 1%, also pose a risk to the rating. And for news coming out of Europe, let's join DWTV Channels TV correspondent Javier Arguedas for details. Good afternoon, Javier. Now, all eyes today are on Janet Yellen and, oh yeah, you're welcome. All eyes are on Janet Yellen and her statements on the U.S. economy. What are investors expecting?
Well, investors are not really expecting a clear answer to the big question that they have, but we know that that question is whether there will be an interest rate hike in June or July. Those are the two alternatives. They certainly will be looking at every single word coming out of Janet Yellen because they really want to know where to put their money now. Let's not forget that right now the probabilities are more on the option of having that interest rate hike in July. That means a little bit of a hit to the U.S. economy. Those statements that we'll hear from her today come at a time where the United States economy has been recovering quite quickly, has been going quite strong. We will have the latest U.S. data released as well. So all in all those informations will be processed in order to see what is coming the way of investors right now. But what we can say at this point is that all signs from the Federal Reserve so far have led to investors almost discarding the possibility of an interest rate hike in June. That would be a big shock to the markets and is, as we know right now, not that likely to happen.
Oh, Javier, yesterday we saw the oil price go above $50 mark. Now, the price again dropped below the $50 mark today. Is that something to worry about?
Well, not really. Most of the interpretations of this slight decline in the oil price have been related to people essentially getting their earnings back or taking them away, rather. So in the end, it is not that much of a bad sign. Most experts agree on the fact that as long as we still have these little disruptions in some of the oil-producing countries, and as long as the production levels keep more or less the same, we will have a stability in the oil price price at least until the end of this year. So most experts do not expect a sharp drop or a sharp climb of the oil price in the coming months. If that is true, and if that promise really is held by the oil market, then we'll probably have a stability in the markets in general as well, because of course this has been a major issue at the beginning of the year. We will see what happens in 2017, though. Let's not forget that the oil glut reasons that we had at the beginning of the year have not changed, and that there still is no significant agreement between the oil producing countries to limit the production.
Right. Now, Thursday was a holiday in Germany. Traditionally, there is much movement on a bridge day before the weekend. Wrap up the trading week for us.
Well, this trading week has been very positive, at least for investors here at the Frankfurt Stock Exchange. The DAX, the main German index, has climbed more than 400 points so far. It also managed to not only surpass, but also sustain the 10,000 mark, which is psychologically important. We had seen some movements where the DAX surpassed the 10,000 point mark, but it couldn't sustain it, and now it seems like it's different. And a few of the economic data that we got this week, for example, the Consumer Confidence Index and also the Business Confidence Index, both were actually better than expected. The German economy also grew stronger than expected. So all in all, what we have here are very positive signs after what has been a very difficult beginning of the year. It seems like things are recovering slowly. The other big element of this week was, of course, what we just talked about, the stabilization of the oil price. That gave many companies a boost, especially banks that financed the oil companies and that had fears of potential companies going bankrupt. Now, those fears seem to have dissipated for now. And last but not least, we had, of course, the G7 summit, which was rather disappointing in the sense that it did not bring any inspiring outlooks on how the economic future is going to look like. More or less, we saw some statement of leaders saying every country is going to do whatever they can, but shouldn't they always? Back to you.
Thank you very much, Javier, for those updates. Thank you for your time and enjoy your weekend. Javier Aguedas, DWTV Channels TV financial correspondent, reporting there from Frankfurt Stock Exchange. Well, a declaration at the G7 meeting in Japan says a vote by the UK to leave the European Union would pose a serious threat to global growth. In its final statement, the group warned that a UK exit from the EU would reverse the trend of increased global trade, investment and jobs. Meanwhile, Japanese Prime Minister Shinzo Abe and other leaders from the group of 7 nations met leaders of outreach countries and organizations on Friday, including Director General of International Monetary Fund Christine Lagarde and Guinea's Prime Minister Peter O'Neill.